TV 18. This is Bazaar Morning Call, broadcasting live from the CNBC TV 18 Motilal Oswal studios in Mumbai.
Good morning. We're coming out of a weekend. It's a Monday morning. You're with us here on a fresh new edition of Bazaar Morning Call. We're coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Prashant, with me, my colleagues Sonia and Nigel. Guys, hi, good morning.
Hi, good morning. Good morning, Nigel. Well, it's a hectic week. A lot of queues coming through, but it's also a really truncated week. So we have only 3 working days, but lots to pack in that time. There's the RBI policy as well. Then we head into earnings season. So I guess we got our work cut out for ourselves, but lesser number of working hours.
Yeah, I mean, Monday's a holiday, and then Friday's a holiday. So that's
Tuesday's a holiday.
Tuesday's a holiday, sorry. Yes, Tuesday. Friday's a holiday. But, you know, there's always something, right? I mean, this morning, there's oil to talk about. Yeah. That is a new thing. So let's start with that, because I think as we begin a new trading week, a truncated one nevertheless, I think the big cue is that oil prices have jumped about $5 a barrel. Now, who would have thought? Suddenly, out of the blue, Sunday night, OPEC Plus surprised the markets with a big output cut. I mean, actually, it is big. It totals about 1.6 million barrels per day. And they're taking a lot of oil out of the market, just as expectations are that demand should perhaps be steady, if not pick up a little bit, with China fully coming into the market in 2023. So, you know, it's a bit of a shock reaction as far as oil markets are concerned. We got brokerages like Goldman Sachs, etc., saying that this basically means that their average price, oil price for, I think, second half of this year moves up to about $95 a barrel. It does provide this comfort to at least oil suppliers that they'll be able to extract higher prices even if the world goes into a bit of a slowdown. The implication is very simple. You know, inflation has been coming off in the US. Inflation has been the big problem all the way from late 2021. 22 was a problem. 23 is expected to remain a problem. And things like this affect inflation across the board, developed markets, emerging markets, etc. So inflationary impulses due to the jump in this 5% jump, I think we need to wait and watch. The unknowables at this stage is, will it stay contained at a $5 jump, or will it become more? And how long will the strength last? Which I think at this point in time, we don't know. But this is important, especially for a big oil importer like India. This news item, I think, will be closely watched. Otherwise, I mean, you know, had it not been for this, global sentiment continued to improve. And we were making this point all of last week as well. On Friday, the Nasdaq ended about 1.7% higher. The S&P 500 was up. You know, so I was saying this on Friday morning and Thursday morning as well. Around the time when, markets get visibility that we are going to see the last of Fed rate hikes, yields collapse. Usually, typically going back in history, nominal and real yields come off sharply. That is very positive for technology, startups, companies where they don't make money now but will make money into the future, new age, digital companies, etc. as well. So keep an eye out on that space. The 10-year lost about 8 basis points on Friday, the US 10-year. Otherwise, also, data from Friday, this is the Fed's balance sheet, shows that deposit rotation from small to large US banks is stalling, which is very good news. The concern was that smaller regional banks will continue to be in trouble and people will prefer to keep their deposits in larger banks, triggering a bit of a crisis. That is also stalled. This is data, mind you, for the week ended March 22nd, but the data came out last Friday. Okay, let's just come to the market here. Nifty is broken out from the congestion zone. We had a nice rally. We started 100 points higher on Friday and added 150 on top of that by close. We closed above the 20-day moving average on the Nifty as well. We've also seen positive weekly and monthly closes. Technically, this is significant. In the near term, the 40-day exponential moving average comes into play. That stands at about 17,406. So we closed at 17,359, very near term. It's another 60-odd points. That's a 40-day exponential moving average. The upper end of the medium-term channel now stands, the downward sloping channel, now stands at 17,630. It is slightly some distance away, some 300 points from where, less than 300 points from where we closed on Friday. But these are near-term levels, 17,406 and then 17,630. Banks lately have been doing even better than the Nifty, at least in the short term. So on the Bank Nifty, the gap formed on the 10th of March, and this is the range which is perhaps likely to act as a very near-term resistance zone. 48.39 and 41.208 will act as the first resistance zone, And the medium-term resistance for the Bank Nifty stands at 41,400. Again, I mean, this is a couple of percentage points, but that's what you need to watch if you're looking at the market on a day-to-day, very near-term basis. You got to also keep in mind this is a holiday shortened week. Tomorrow is a holiday. And then you got one more holiday. A lot of activity will be absent. People away taking a quick break with these holidays helping. So watch out for liquidity. Watch out for these holiday-led interruptions as well, which are technical in nature but become important considerations if you are trading. SGX this morning is indicating a flat start, about 30-odd points or so. Sonia.
Oh, absolutely. And, we would be building on to our gains of last week, right? I mean, the Nifty did quite well last week. It was up almost 2.5%. The Nifty was one of the best performing markets compared to its peers last week. And now, today, we'll just be building on to our gains. There are a lot of positives that this market could latch on to. The domestic cues are also looking good. In fact, the auto sales, which is a key barometer of sentiment in the economy, has seen a bit of a pickup, especially the likes of Maruti, Hero Motocorp, the auto guys that are exposed to the rural markets. Not bad. Hero Moto saw 15% sales growth. Maruti, in fact, in FY23 has recorded its highest ever annual sales. And the management is quite bullish as well. So domestic cues are sort of stabilizing and picking up, especially the weak pockets. For the US markets as well, we've told you how it was a pretty strong run that we saw on Friday. And the Japanese market, as we speak, is up over 170 points as well, so looking pretty good. But there's lots of data to watch out for. Of course, one eye will be on crude after the surprise OPEC cut and the way crude has moved. But this week, there's a lot of data to watch. So there's the job opening data that happens on Tuesday. There's the ADP private payrolls on Wednesday and the monthly jobs report on Friday. All of these data points will be imperative to gauge which way the market heads from here. There's also the RBI meeting on the 6th of April. There'll be a 25 basis points rate hike that the street is penciling in. So that's something that we're going to focus on as well. You have earnings season that begins on the 13th, with Infosys coming out with numbers on the 13th. And this is important because Infosys will be the first company to give out a full year guidance for FY24. So we'll kind of, gauge which way things are headed from the tech companies. Then there's ICICI Bank on 22nd as well. So all in all, you'd have to say that after a smooth run that the market had last week, perhaps we could build on to our gains today. But let's see, this level has been a bit of a hurdle for the market on the upside. Yeah. Let's see if there are enough and more triggers to take this level out.
Well, the big question is, Sonia, whether or not this is a relief rally, or are things turning around and have the markets decided that they want to move up from here? Well, we'll know that in the coming month itself. The FI as well, they're yet to cover short positions though, so they continue to remain aggressively net short on the index, which, as we've been saying the last few sessions, that's not such a bad thing. FI is net short. If he could hold or move higher, they'll be forced to cover out. But more than the headline index, I'll be watching the broader markets, and I'll tell you why. Because April has historically been a very, very good month for the broader markets. And the last 10 years of put out data, the mid-cap index has outperformed the Nifty on an average. I'll give you another data point. For all of those 10 years, barring 2019, the mid-cap index did better than the Nifty. So that's another data point. Even last year, that's 2022, the Nifty was down 2% in the month of April, but you had the mid-cap index that was up close to around 0.5%. So can this continue? Well, that's going to be very, very important because the broader markets have really got hammered, and there'll be fresh allocation that will come about because it's a new fiscal. So that's an important data point besides the headline index. But getting back to the headline index then, the Nifty and the Nifty Bank, they did well in Friday's trading session, and there was clearly about a short covering as the open interest was lower. What did the FIs do? They didn't cover shorts as yet, but they added some long positions. 4,000 long contracts is what they added. Shorts continue at around close to around 89% of their positions. So the hope is that they were forced to cover out at some point of time. On the options front, well, they're buying more puts than calls. So in case things go wrong, well, there is some protection on the downside. But what's heartening to see is that they wrote way more puts than calls. What were they writing? Well, you have a couple of strikes, 17,300, 17,200 put. Between them, more than a crore shares were added out there. So there was writing being seen and a bit of a punt being taken at around the 17,600 call because big open interest built up and maximum you lose around 15 rupees or thereabouts, which brings us to the level. Since we are seeing writing at around 17,300 and 17,200 put, well, the 17,150 to around 17,200 becomes very important, which is bang in line with around the 20 DMA. On the upside, the 200 DMA will be a bit of a resistance. So 17,500 is what we're looking on the upside. For the Nifty Bank, we saw some writing at around the 40,500 put. So the 40,200 becomes very, very important as a support level. And on the upside, only around 150 points away from here, the 50 DMA. So that becomes a bit of a resistance. SGX Nifty suggesting a bit of a green opening, maybe 20-25 points higher. But what happens from there is important. And yet again, guys, I'm going to be tracking the broader markets because, as I said, history suggests that April is a good month for the broader markets. So, portfolios will be hoping that they can repeat it this time around as well.
Absolutely, and history does rhyme, right? So let's hope it rhymes.
It doesn't always repeat, though.
Repeat rhymes.
But 9 out of 10 times it's happened last.
So it's likely to be a decent one. Well, before we go any further, let me quickly tell you what's lined up in the first half hour of the show today. We'll get you updates from markets across the globe. Ed Yardini of Yardini Research will join in to discuss the global trade setup. Our research team will join in for the top list of stocks to watch. Our research team will get you that. And 8:30, we'll dissect the markets with Prakash Diwan and understand from him the stocks he's got his eye on as well.
All right, let's do one thing. Let's kickstart the show now with a view coming in first up from one of the brightest minds in the business, Chetan Seth of Nomura, who says that in Q1, the US data has been fairly resilient and US inflation has been moderating. Recent banking sector concerns have quickly eased given aggressive and decisive actions from the authorities. While the Fed is likely done with its hiking cycle, as long as these conditions persist, we think stocks are likely to be well behaved.
Let's get you some money market views as well. On the rupee, B. Prasanna of ICICI Bank says the dollar eased as risk sentiment improved with moderation of banking crisis risk in the US and Europe. He says rupee outlook remains positive with improvement in the current account gap. He expects the dollar INR pair to take cues from the RBI MPC decision this week and trade between 81.8 to 82.8 to a dollar.
And on the bonds, V. Prasanna of ICICI Bank says global yields hardened initially in response to easing contagion risk but fell later due to lower inflation print and softer economic data. Local bonds remained under pressure as resumption of supply and upcoming MPC meeting kept participants in risk reduction mode. He expects yields to remain range-bound going into the RBI policy, where the odds seem to be even between a hawkish pause and a dovish hike. Prasanna expects the 10-year benchmark to trade in a range of 7.2 to 7.45%.